I don't think inflation is well and truly dead until you see some pain across, and I don't mean everybody, there's pain across the economy. I get that. But some pain at the macro level in terms of the employment and wage figures. I hope the Fed doesn't take their foot off the brake too soon, because my expectation is if they do, then inflation will roar back on this, unless you see some demand destruction through job losses.
If we look at the current rally, you already mentioned it, the elephant in the room, the monthly CPI report. We obviously got that huge rally after the most recent inflation report showing that the US economy is probably disinflating by now. But how do you gauge this inflation discussion into year end? Is it a discussion that you take part in? How do you assess it in your portfolio construction?
I don't generally try to predict prints, so to speak. I do look at sort of the pressures that are influencing the path of inflation more so than any one particular guess. There are people that do that very well. Some of them have real alpha. But I don't do that. I'm looking at the pressures, and, my view on the pressures is that inflation won't be well and truly killed until jobs, either some sort of financial breakage occurs where either a provider of leverage or a large industry is taken out, and jobs are cut after the breakage, or jobs need to come down because the consumer, though they're spending quite a lot and levering up some of their credit card debt, they are doing that because they expect to be employed. You don't lever up your credit card always because you're about to go bankrupt. Sometimes you do it because you expect to get a bonus or you expect to keep your job, and so you just want to spend ahead of that. And so the demand side, true demand destruction, is only going to happen if we see consumers being forced to retrench, and that happens when the job market turns. And so I don't think inflation is well and truly dead until you see some pain across, and I don't mean everybody, there's pain across the economy. I get that. But some pain at the macro level in terms of the employment and wage figures. I hope the Fed doesn't take their foot off the brake too soon, because my expectation is if they do, then inflation will roar back on this, unless you see some demand destruction through job losses.
So what's your base case on the Federal Reserve right now? Are they going to strike back against what we've seen recently in asset markets, or will they allow it to unfold? What's your takeaway from the recent communication from the Federal Reserve?
Yeah. There's some internecine differences of outlook that have been part of the Fed rhetoric since I've started watching it. And this time is the same. Brainerd was dovish, and it really depends on Powell and all those sort of things. My basic picture is what is consistent with what Powell said, which is the threat is inflation, and we're not experiencing any pain. So why not persist? That doesn't mean 75 in December. That doesn't mean a terminal rate of 4.5 or 4 3/4 or 5. It just means persist. And so for me, I expect the Fed to persist until inflation is well and truly dead. And that's going to be months from now. And so, I'm on board with the current pricing. It's a little rich right now, but on board with the current pricing of something like 125 basis points between now and when they pause for an extended period of time.
That's one of the next questions that we're going to ask to the Fed, because one thing is obviously to pause, but as soon as you pause, at least seen in history, the market is starting to chase a potential pivot into a cutting cycle, right? What do you make of that discussion into next year, a pause rather than a full pivot?
Right. So I have no expectation of a full pivot. I see no reason to do that whatsoever. And I'm also considering politics, which is, easing, pivoting in before the election cycle even gets started serves no political pressure agenda. So I don't think the administration is going to be putting pressure on the Fed until they actually see some pain that might be politically difficult. And we'll see about that. But, that's my outlook on that. But I think the most important thing to recognize is that the transmission mechanism for rate hikes in the U.S. is very different than it was decades ago, and very different than it is in versus other countries. Rate hikes affect consumption because they may make cash look attractive relative to using it and spending it for goods. But they also make leverage more expensive. But the U.S. Homeowner, the marginal homeowner that has to relocate is faced with high mortgage rates. But the holders of mortgages on existing homes, they're flush. They have interest rates that are, less than 3% in some cases. And those aren't going up for 30 years. So that transmission mechanism in the U.S. is just difficult. And so you have to use the wealth effect. That's your only other lever. And that means that negative reinforcement whenever asset prices go up. And we've seen both equities and bonds, but in particular bonds, gold, other assets, all spike since the Fed. And that's not what they want. Regardless of your opinion of the divisiveness within the Fed, none of them want an asset rally. So I expect they'll correct that at some point in time, unless the numbers just magically fall. And I don't think they can magically fall without jobs magically falling.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.